Hey, what's up, everybody? It is Friday, May 6th. So, a couple of things I want to cover today. I think I found out what the problem is. First of all, we had another lousy day in the market, if you're bullish, but we did have somewhat of a recovery toward the end of the day, and the Dow and the S&P, the Nasdaq was not looking too good. Now, yesterday I made the video. I was talking about how this month we're going to get that swimming pool, using the swimming pool analogy, we're going to get the swimming pool filled back up. April, big hole, big drain in the swimming pool. All the water went out and then some, with the huge surplus in April. And I was saying that, the government takes that money in tax time in April and then it spends it back out again. But that is happening very slowly. Now, one thing I did today, which I don't normally do, I don't normally check the federal budget balance every day. And the reason I don't check it every day is because, for years we've been running big deficits. So basically, really, there's only been 1 month every year, that's April, where the government will show a surplus in its balance. But we saw this kind of quirky thing now. We saw it in January. If you go back to my January videos, I was actually warning about it. I said there's a surplus, the market's going to be in trouble, the economy is going to be in trouble, and then we quickly flipped back around in February and March to deficits in those months. And by the way, that January surplus, I think, was the result of the federal government selling off broadband, what do they call that? Just broadband spectrum, part of the broadband spectrum. I think they took in like 80 billion, the federal government took in 80 billion selling off some of the broadband spectrum, so that was the reason for that. And April, of course, we have the tax collections, and that it was a huge, I talked about that yesterday. I mean, the government took in almost $1 trillion in April. The deficit, the surplus in April, I think it was like 360 billion or something like that, or 330 billion. It was huge. But and again, what's a surplus? It's literally the draining out. I mean, you could understand it because you pay taxes, so your account gets drained out. It's not hard to understand. I mean, that's something we can all feel. That's something we all intrinsically, automatically understand, because you write that check to the IRS, to the Treasury, and boom, that just comes out of your account, and you feel drained. It takes a while for that money to build back up in your account, through your work or your business activities or whatever. But here's the thing, and I think the market is really, really trying hard to make a bottom in here. And I say this because I just looked at the budget balance for May so far, and we're the most recent Treasury Statement is May 5th. That's yesterday. And we're still at a 31 billion surplus. So nothing has started to flow back. Yesterday when I talked about, hey, the hole in the swimming pool's been patched, we called in the masonry guys and they patched the hole. They didn't do such a good job, or they haven't showed up yet. I mean, we're running now. We're the first week in May. This is the first statement week in May. Now, maybe today had some interesting price action. We'll have to see next week. But so far, through the 5th of May, that's through yesterday, government's still running a surplus of like 31 billion. So that's a problem, because what a surplus means is that everything that is spent out into the economy is immediately sucked back and then some. All right, so it's a net drain. So this drain is continuing. Now, again, I'm going to say this, that I don't expect that drain. I don't expect surpluses to be a a feature now, a regular feature now as we go through the rest of the fiscal year. Like, I'm absolutely certain that it's going to flip back into deficit, which would mean that liquidity is coming back in again. It's coming back into the economy. It's coming back into deposits. It's coming back into the market. But right now, through the 5th of May, I'll repeat it, we still have a fiscal surplus. And I hope you're understanding that I'm really trying to point this out on two levels. Number one, I'm trying to point out from a trading level, how these liquidity changes, and this is true liquidity. This is not like Fed monetary operations, which that does not constitute any change in liquidity. It is simply, again, a recomposition of the financial assets in the economy. But fiscal flows, that's real liquidity. That's either putting it in, government sends out a check or deposits something in your account, that's there, or it takes it away, it taxes you, you have to pay it if your balance goes down. Those are real flows, like the tides coming in and going out. We need a tide to come back in again. And again, it hasn't been a habit for me to look at the fiscal balance on a daily basis, just because for years, that was not even a concern. We're running deficits all the time. But now it's getting a little sketchy, I have to say. But I will repeat, I don't think this is going to be a continuous feature now as we go out through the rest of the fiscal year. We got May, June, July, August, September. We got 5 more months in the fiscal year. And May should and will turn around. But I said today was an interesting day because the way the market tried to recover at the end of the day, it makes me believe that when we see the data on Monday, in other words, when I see Friday's daily Treasury Statement, there's a good chance we flipped back at least close to balance. In other words, wiping out that surplus. And by next week, I think that surplus is going to be gone and we'll be back into deficit, and that's what we need. I also want to mention something about next week. Actually, one thing I want to mention, and then something that's correlated to that. First, I'll mention the thing that's correlated to that. Today we saw if you looked at that FedWatch tool, I've spoken about that in the past. The CME you could get it online if you go to FedWatch tool, if you Google that. The CME has this tool which takes the current pricing of Fed fund futures, and from the price of Fed fund futures, it can predict, or it shows the probability what traders are expecting in terms of monetary policy actions, in terms of rate changes. And up until yesterday, basically, it was showing a 50 basis point increase, or forecasting a 50 basis point increase at the June Fed meeting. However, today, it popped up to a 75% basis point increase, and that became like an 89% probability. So it jumped way up there. Now, that's the correlating thing, or the side thing that I wanted to mention. What I really want to point out is that next week, okay, on Wednesday and Thursday, we're going to get the CPI for April and the producer price index for April. Okay, so Wednesday we'll get the CPI, Thursday we'll get the PPI. I don't think anyone's paying much attention to that, but the CPI forecast, if you look at what the forecast for April CPI, it's showing up 0.2%. That's it. And the PPI is showing up 0.5%. So the 0.2%, just to put it in perspective, the last CPI for March, that was up 1.2%. So that is a huge deceleration in inflation, at least in the forecast. I'm not, I don't know what it's going to end up to be, but most of the time these forecasts are pretty close to being accurate. So next Wednesday, if we get that CPI at a 0.2, and look, 0.2, if you multiply that by 12 or to look at it over a year, that's 2.4% inflation. I mean, we had that for 20 years and nobody was, screaming hyperinflation. That was totally normal. So we could be coming back down to those levels. And the PPI forecast of 0.5, that's they're expecting to see in next Thursday. March PPI was 1.5%. So again, that's a big deceleration in producer prices. So what am I trying to say? I think the expectation now for a 75 basis point hike in June is just, I think it's crazy. I don't think the market is factoring in, or I don't think traders, investors are factoring in how these next week's forecasts are going to be way lower than prior months and coming back in line to what historically we have considered to be, normal levels of inflation. This could actually set up a big bond market rally, because the bond market, I mean, today, what we got up to like, I think 310, or I think at one point it might have been 311, 312, 313 on the 10-year. So next week is going to be very interesting, and I think you got a bunch of factors coming together next week, flipping back into deficit for the fiscal balance, and also these two data releases, CPI on Wednesday and PPI on Thursday. That could be a big surprise from the standpoint of decelerating inflationary pressures. And that could rattle things big time because, what's driving the market now is the fear of interest rates and inflation. By the way, I should add that today we got the payroll numbers for April. They were really strong, 428,000 new payrolls. That was way above estimates. I think estimates was something like 330 or 350K. So 428, and my data, same thing that I look at, which is the average daily unemployment benefit flows. I mean, they're very, very low. So at least that data is kind of showing low level of layoffs, or another way to characterize or get a reading on the strength of the labor market, and that's saying that the labor market is strong, and we saw that today with the job numbers. Now, in a weak economy, you're not going to be growing jobs at 430,000 a month. So again, I mean, it's just like the economy's okay, the labor market's okay. What's happening right now is an intense fear about interest rates. And I think next week we could have an adjustment in some of those expectations. Like, I'm looking forward to Wednesday and Thursday to see what's going on. Anyway, today's Friday, so I want to relax a little bit. It was kind of a rough week. All right, everybody. I hope you enjoy your weekend. Maybe I'll be able to make a video tomorrow. If not, have a good one. Bye.